Bitcoin was pushing toward resistance near 67,000 to 68,000, and on the surface, short calls looked obvious. But when implied volatility had already risen from an extremely depressed 7 to about 19.1, the more important question was not direction. It was regime. That is why I skipped the short calls and used only a quarter of the intended budget to buy a 30 delta strangle with about 45 days to expiry. This is one of those trades that feels less intuitive than it should. Price looked extended. Bitcoin was firm, oil had rebounded hard from around 70 to 84 or 85, gold had recovered, and SPY was still hesitating near all-time highs. If you only looked at the chart, selling upside premium made sense. But markets do not pay us for being plausible. They pay us for being positioned correctly when the distribution of outcomes starts to change. The key detail for me was not that IVP was high. It was that IVP had risen meaningfully off a very low base. Going from 7 to 19.1 is still not expensive in absolute terms, but it is a real change in character. After a long period of compressed volatility, the first move higher can matter more than it looks on the chart. That is where short premium can become fragile. The temptation in a setup like this is to say, Bitcoin is near resistance, therefore short calls. But that is too simple. The real question is whether the market is still in a quiet, mean-reverting regime, or whether it is waking up. Oil's rebound, the firmness in other risk assets, and the rise in implied volatility all suggested that the market might be transitioning. In that kind of environment, selling calls can mean shorting convexity just as the range begins to expand. I was also influenced by what I had already done earlier. When IVP was extremely low at 7, I had flattened all positions. That mattered. It meant I had already recognized that the market had become too quiet to justify staying heavily exposed. Once volatility begins to reprice, it becomes reasonable to reconsider whether the edge is now in owning movement rather than selling it. So I chose not to force the short call trade. Instead, I allocated only about 25% of the intended budget, or $3,000, into a 30 delta strangle with roughly 45 days to expiry. That was not a big expression of conviction. It was a controlled way to participate in a possible volatility expansion without overcommitting capital to one interpretation. That is the lesson here. Long strangles are not automatically better than short calls. The lesson is that trade size should match regime uncertainty. If the market is compressing and then begins to stir, optionality may be more valuable than yield. But optionality is still a wasting asset, so the budget has to be limited and the time horizon has to be explicit. Do not confuse resistance with free money. Track IVP and the direction of change, not just the absolute level. Ask whether the market is stable or transitioning. Size the trade so that being wrong does not impair the portfolio. Sometimes the best trade is not the most profitable one on paper. It is the one that keeps you flexible for the next regime.